Wake up. The holiday party is over. It is January 4th, 2026. You're probably nursing a hangover from New Year's, looking at your portfolio, and thinking, okay, 2025 was volatile, but the worst is behind us, right? Rates are coming down. The Fed is saving the day. I hate to be the one to tell you this, but you might be dead wrong. While you were watching the ball drop, something critical happened in Philadelphia that the mainstream media glossed over. The Federal Reserve isn't just tapping the brakes, they are thinking about rewriting the entire rulebook for 2026. And the gap between what Wall Street expects and what the Fed is actually planning to do has just become the most dangerous risk to your net worth. We have a labor market that is bleeding out, an administration launching a massive immigration crackdown that's warping supply chains, and a Federal Reserve president who just went on record saying that rate cuts this year are not a guarantee, they are a luxury we might not afford. Wall Street is pricing in a party. The Fed is preparing for a funeral. If you own stocks, if you're trying to buy a home, or if you're just trying to keep your grocery bill from exploding again, you need to understand the signal that just came out of the Philadelphia Federal. Because if you're betting on the soft landing narrative, you are walking blindfolded into a buzzsaw. I'm going to break down exactly what Anna Paulson said, why the data is lying to us, and most importantly, how to position your money before the market realizes the game has changed. Let's peel back the first layer of this onion. Yesterday, Federal Reserve Bank of Philadelphia President Anna Paulson took the stage at the American Economic Association's annual meeting. Now, usually, these speeches are boring academic snoozefests. But not this time. Paulson dropped a bomb wrapped in polite economic language. She said, quote, if all goes well, some modest further adjustments to the funds rate would likely be appropriate later in the year. Let's translate that from Fed speak to plain English. Wall Street and retail investors, people like you and me, have been betting the farm that the Fed would slash rates aggressively in early 2026 to save the labor market. The market is pricing in at least 2 cuts, starting soon. Paulson just told them, dream on. She used the word modest. She used the word later. She didn't say Q1. She didn't say Q2. She's talking about the back half of 2026. Why does this matter? Because of the lag effect. Monetary policy works with a lag of 12 to 18 months. The rate hikes of 2024 and 2025 are still breaking bones in the economy today. If the Fed waits until later in 2026 to cut rates, they are essentially letting the current high rates crush the economy for another 6 months. Paulson admitted that current policy is a little restrictive. That is the understatement of the century. For a small business trying to refinance a loan, or a startup trying to raise capital, restrictive means insolvency. The disconnect here is massive. The median projection from policymakers is for only 1/4 point reduction this entire year. Investors are betting on 2 or more. When the market expects free money and the Fed gives them higher for longer, asset prices collapse to close the gap. We saw this in 2022. We saw it in the 1970s. And we are setting up for it again right now. But why is the Fed being so stubborn? Why not just cut rates and let the good times roll? Because they are terrified of a ghost from the past, the second wave of inflation. Paulson explicitly mentioned that the impact of tariffs on goods prices would likely keep inflation elevated in the first half of 2026. Here is where politics crashes into economics. The Trump administration has ramped up tariffs. We all know the political arguments, but let's talk strictly about the math. When you slap a tariff on imported steel, electronics, or textiles, the price of everything from your washing machine to your new car goes up. This creates a nightmare scenario for the Federal. They want to cut rates to help the economy, but they can't because tariffs are artificially pumping up inflation numbers. It's like trying to put out a fire while someone else is pouring gasoline on it. And it gets worse. Paulson highlighted a bizarre contradiction in the labor market. She said that demand for labor is decelerating, which usually means wages should go down. But, she also noted a supply drain stemming from the Trump administration's crackdown on immigration. This is Economics 101, but twisted into a knot. You have fewer jobs available, but you also have fewer workers available to take them. Think about the construction industry or agriculture in California and Texas. If you deport a significant chunk of the workforce, who builds the houses? Who picks the crops? The labor supply shock means that even though the economy is slowing, businesses might still have to pay higher wages just to find anyone to work. That is inflationary. So, the Fed is trapped. They see the economy slowing, but tariffs and labor shortages are keeping prices high. Paulson is saying they are choosing to wait. And while they wait, your purchasing power continues to erode, and the cost of borrowing remains sky high. This is the stagflation-like scenario that destroys the 60-40 portfolio. Stocks drop because growth slows, and bonds drop because inflation stays sticky. Now, I know what the bulls in the comments are going to say. But wait. The US economy expanded at an annualized pace of 4.3% in the third quarter. That's booming. How can you be bearish? This is the most dangerous number in the entire report. Yes, GDP is up 4.3%. But unemployment has risen to a 4-year high of 4.6%. How on earth do you get booming growth and rising unemployment at the same time? Two words, productivity and AI. Paulson left the door open to the idea that AI is finally driving a meaningful boom in productivity. In a normal recovery, companies grow by hiring more people. In an AI-driven economy, companies grow by firing people and buying software. If a company fires 1,000 mid-level managers and replaces them with an AI integration that costs a fraction of the price, their profits go up. Their output goes up. GDP goes up. But the people are unemployed. This is the jobless growth phenomenon. For the stock market, specifically the S&P 500, which is dominated by tech giants, this is great news. Margins expand. But for the real economy, for you, your neighbors, and the consumer base that actually buys products, this is a disaster in slow motion. If unemployment hits 5% or 5.5%, consumer spending will crash. And since consumer spending is 70% of the US GDP, that 4.3% growth number will evaporate overnight. The Fed knows this. Paulson said, officials won't know in real time whether higher growth was due to elevated productivity. They are guessing. They are hoping that this is a productivity boom like the 1990s internet era. But if it's just a temporary sugar high before the consumer breaks, then holding rates at these levels is a policy error of historic proportions. It gets even scarier when you realize the Fed isn't just guessing about AI, they are guessing about everything. Paulson admitted that the recent federal government shutdown has complicated the interpretation of the economy. We are flying a Boeing 747 through a hurricane, and the radar system just went offline because of a budget dispute in Washington. The data collection on inflation, jobs, and retail sales has been disrupted. Paulson explicitly said her outlook doesn't take signals from the most recent unemployment print. Do you understand how insane that is? The Federal Reserve determines the price of money for the entire planet. They control the liquidity of the global financial system. And they are making decisions based on old data and vibes because the government couldn't keep the lights on. When investors realize that the Fed is flying blind, volatility explodes. Markets hate uncertainty. If the Fed keeps rates high because they think inflation is sticky, but real-time data shows the economy is crashing, they will pivot too late. This is exactly what happened in 2008. By the time the data confirmed the recession, Lehman Brothers was already gone. So, we have a hawkish Fed, a confused data set, a labor market that is bending, and tariffs keeping prices up. What does this mean for your money in 2026? Let's break it down by asset class. 1. Real estate. If you are waiting for mortgage rates to drop to 4% or 5% this spring to buy a house, Paulson just poured cold water on that dream. With the Fed projecting only one cut late in the year, and investors pricing in two, the bond market is going to have to reprice. When the market realizes the Fed isn't bluffing, the 10-year Treasury yield will spike. Mortgage rates follow the 10-year. We could see rates tick up in Q1 and Q2 of 2026 before they ever come down. If you are a seller, the buyer pool is about to shrink even further. If you are a buyer, wait and see might be the only strategy, but cash is king. 2. The stock market. The divergence between GDP and unemployment creates a bifurcated market. Companies with high labor costs are going to get squeezed by the immigration crackdown and wage pressures. Avoid them. Companies that are leveraging AI to fire people will likely continue to show strong earnings until the consumer breaks. But be careful. The market is currently priced for a perfect soft landing. Paulson's speech suggests a bumpy landing with turbulence. Any shock, a bad earnings report, a higher inflation print, could trigger a 10 to 15% correction as the rate cut premium is wiped out. 3. Bonds. This is the tricky part. Usually, when the economy slows, you buy bonds. But if inflation stays high due to tariffs, bonds lose value. However, Paulson said, while the labor market is clearly bending, it is not breaking. Bending not breaking is famous last words. It's what they said in 2007. When it finally breaks, it snaps. When unemployment crosses a certain threshold, the recession rule triggers. We are almost there. When it snaps, the Fed will panic cut rates, not modestly adjust them. In that scenario, long-term treasuries become the best hedge in your portfolio. So, how does the rest of 2026 play out? Based on Paulson's signals and the macro backdrop, we are looking at two distinct paths. Scenario A, the immaculate disinflation. The AI productivity boom is real and massive. It allows companies to maintain high output without hiring, keeping inflation down despite tariffs. The Fed holds rates steady until Q4, then cuts once as a victory lap. Stocks grind higher, but the wealth gap widens as unemployment stays structurally higher. Scenario B, the policy mistake crash. The Fed holds rates too high for too long, obsessed with tariff-driven inflation that they can't control with interest rates anyway. The labor market bend turns into a break by Q2 2026. The immigration shock causes a wage price spiral in services, while the rest of the economy collapses. The Fed is forced to emergency cut rates by midsummer, but the damage to credit markets is already done. Paulson's speech pushes us closer to Scenario B. By delaying cuts to later in the year, she is increasing the tension on the rubber band. The further you pull it back, the harder it snaps. Listen, nobody wants a recession. Nobody wants their portfolio to tank. But hope is not a strategy. The Federal Reserve Bank of Philadelphia has given us a roadmap. They told us they are looking at lagging data. They told us they are worried about tariffs. And they told us they are not in a rush to save the market. Wall Street is playing a game of chicken with the Fed, and historically, the Fed always wins. So, what should you do? 1. Hoard cash, you need optionality. If the market corrects 20%, you want dry powder. 2. Watch the claims, forget the monthly jobs report, watch the weekly jobless claims. If they start spiking, the bending is over, and the breaking has begun. 3. Ignore the politics, it doesn't matter if you like the administration or hate them. Focus on the mechanics of the tariffs and immigration policy. How does it affect the companies you own? The year 2026 is not going to be the smooth ride the bulls promised. The turbulence is just starting. As always, I'm watching the data so you don't have to. If you want to survive the 2026 correction, make sure you subscribe and turn on notifications, because the next Fed meeting might just determine the fate of the US dollar. Watch your portfolio. Stay liquid. And I'll see you in the next one.